Now, it's very important that you know that the Consumer Finance Protection Board wrote an amendment to Tila known as the Loan Originator Compensation Rule. This rule prohibits what's known as dual compensation. This is where a loan officer is restricted to getting paid either by a borrower or a lender, but not both. Based on this rule, compensation cannot be based on the loan terms that the borrower receives. Previously, loan officers could use what was known as yield spread premium as a way to increase their compensation by giving the borrower an interest rate that it was higher than what they actually qualified for. So the Consumer Finance Protection Board wrote the Loan Originator Compensation Rule to avoid this abuse. Now, we've talked about the APR and how crucial it is to disclose those terms of the APR in advertising according to Tila. But remember, the APR is the rate for who? The APR is a rate for borrowers who meet the minimum standard of the loan. But what about the borrowers who don't meet those minimum standards for a loan? What options do they have? The borrower who does not meet the minimum requirements for a loan qualifies for one of two loans. The first is known as a Section 32 loan, and the second is known as a Section 35 loan. A Section 32 loan is known as a high-cost loan. A high-cost loan is a loan where the APR is greater than the average prime offer rate by more than 6.5% for a first lien of $50,000 or more, and also 8.5% on a first lien less than $50,000, or 8.5% for a subordination lien. On high-cost mortgages, there are no prepayment penalties. HUD counseling is required. Proof of ability to repay is required, and there are no balloon payments. A Section 35 loan is known as a high-priced loan. A high-priced loan is a loan where the APR is greater than the average prime offer rate by more than 1.5% on a first loan, 2.5% on a jumbo loan, and 3.5% on a second loan. On high-price mortgages, there is a prepayment penalty that is limited to the first 2 years of the loan. Otherwise, prepayment penalties are generally prohibited. The borrower must prove their ability to repay the high-price mortgage loan, and the borrower must have an escrow account for at least 5 years if there is a first lien on it, unless the payments are up to date and the borrower has an 80% loan to value. The way that I remember that a high-cost mortgage loan is a Section 32 loan is that the letter C comes sooner in the alphabet, just like how the number 32 comes before the number 35. Therefore, we know that high-cost loans are Section 32 loans and high-priced mortgage loans are Section 35. Now, the way that I remember the percentages on high-cost mortgages versus high-priced mortgages is by thinking of it this way. When you go to a store and you see a tag, it shows you the price. But then you go to purchase the item, you go to the cashier, and tax is added. So now you know the actual cost of the item. Therefore, when it comes to high-cost loans, the cost is greater, or in our case, the percentages are higher than the high-priced mortgage loans. Are higher than the high-priced mortgage loans. The high-cost mortgage loans are 6.5% and 8%, whereas high-price mortgage loans are 1.5%, 2%, 2.5%, and 3.5%. Keep in mind, the high-cost mortgage loans and the high-priced mortgage loans are for borrowers who don't meet the minimum standards on a home loan. But just because they don't meet the minimum prime standard, a lender can use a high-cost mortgage or high-priced mortgage by increasing their level of liability if the loan defaults or the home goes into foreclosure. There is a type of mortgage, however, that does reduce the level of liability that a lender has on a loan, and this type of mortgage is known as a qualified mortgage. A qualified mortgage must adhere to the standards set forth by the federal government. It is important to note that a qualified mortgage has no excess points and fees, and the points and fees paid by the borrower, in fact, cannot exceed 3% of the total loan amount borrowed to be considered a qualified mortgage. A qualified mortgage must not exceed a 43% back-end debt-to-income ratio. It must not have terms greater than 30 years, and a qualified mortgage must not have negative amortization. A qualified mortgage must not have interest-only loans, and it must not have balloon payments. A qualified mortgage is presumed to meet the ability to repay requirements. Now, it is important that you remember that there are 8 items that a lender must consider to determine whether or not a borrower meets the ability to repay requirements of a loan. Those 8 items are the evaluation of the following: current income or assets, current employment status, a borrower's credit history, the monthly payment for the mortgage, a borrower's monthly payment on simultaneous mortgage loans, monthly payment on other mortgage-related expenses such as insurance and property taxes, etc., other debts of the borrower, and the borrower's debt-to-income ratio. It's important to note that a finance charge are the costs of receiving credit paid by the borrower. So let's think of it this way. If the borrower is financing a loan to purchase a property, they would also have finance charges. However, if a borrower pays in cash, no finance charges are accrued because nothing is being financed. So some examples of a finance charge could be wire transfers and mortgage interest payments. However, hazard insurance and home inspections are not considered to be a finance charge because both would be required regardless of whether the property was financed or paid in cash. Now, it's important that you understand that for the purposes of calculating the APR, the following acronym helps us to determine what is not considered to be a finance charge. Finance charges do not include security interest charges, the credit report fee, reasonable fees, appraisal fees, points paid by the seller, and a notary fee. I like to use the acronym SCRAPIN. So I like to say, I don't want to be scraping by on finance charges, so this is what is not included on finance charges: security interest charges, credit report fees, reasonable fees, appraisal fees, and points paid by the seller. Again, these are all fees that would be required regardless of whether someone financed a home or paid for the home in cash. Now that we've covered finance charges, let's make sure we understand what prepaid finance charges are. Now, prepaid finance charges are charges that are paid separately before or at the time that the loan closes. So some prepaid finance charges are included in the calculation of the APR. Some of these could be origination fees, discount points, lender fees, closing fees, flood certification fees, buy downs, FHA, UFMIP, or we can remember that as FHA's upfront mortgage insurance premium, VA funding fees, warehouse fees, mortgage insurance reserves, mortgage insurance premiums, per diem interest, underwriting or processing fees, and tax service fees. Now, I know that remembering all of those terms can be quite daunting and overwhelming. So when I was preparing for the exam, I studied what specific fees are not included in the prepaid finance charges used in APR calculations. And we can remember that through an acronym known as 10 CATS. TENCATS. 10 CATS stands for title insurance, escrows, notary fees, credit report charges, appraisal fees, termite inspection fees, and seller credits. Remember, these are what are not included in the prepaid finance charges. Now, I do like to think of prepaid finance charges as unofficial closing costs, but primarily what you need to know to make sure that you understand about prepaid finance charges is that they are paid separately, meaning before or at the time of loan closing. So the biggest difference that you need to understand between what a finance charge is compared to what a pre-finance charge is that a finance charge is figured into the APR and is a condition of the loan, whereas only certain prepaid finance charges are figured into the APR. But the key idea here is that the prepaid finance charges must be paid at or before closing. When we talk about TRID, we are talking about the disclosures that have been integrated together from both Tila and RESPA. So the acronym TRID stands for Tila RESPA Integrated Disclosures. This will be a bit of a review because we have gone over this information in previous modules, but it will be helpful for you to understand which disclosures were integrated together to establish TRID. According to TRID, the definition of an application is described as a borrower submitting the following 6 items. Do we remember the acronym we used to remember the 6 items of a complete application? Yes, it is NALIES, NALIES, which makes up the borrower's name, address, loan amount, income monthly, estimated property value, and social security number. Once this application is received, it triggers the creditors to give the loan estimate, which is due on or before 3 days after the receipt of the application or put in the mail on the 3rd business day. According to TRID, a borrower is considered to have received the disclosures 3 days after they have been mailed. The soonest that a loan can close is 7 days after the disclosures are mailed. So just to make this a little more clear, if the disclosures are being mailed on a Monday, day 1 starts on Tuesday. They are considered to be received by the borrower on Thursday, as long as there are no public holidays, and the soonest this loan could close would be the following Tuesday. Remember, we always exclude Sundays and federal holidays, and Saturdays are included in the calculation when we are talking about the initial disclosures. TRID also states that a lender or broker may only charge a borrower a reasonable credit report fee until they have received the loan estimate and have expressed intent to proceed. This is really important because without the expressed intent to proceed, the deal is dead. This expressed intent to proceed can come in the form of a verbal affirmation over the phone, in a text message, email, snail mail, signing a form, etc. However, silence from the borrower, is not consent.